Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We're certainly not an investing podcast, but we do enjoy talking to professional investors about what they like and what they look for when examining companies. It's particularly interesting as we get towards reporting season here. Of course, we're in the middle of reporting season on Wall Street, just finding out just how companies have performed and, more importantly, what lies ahead. Remember, this is general information only and you should seek professional advice before making any investment decisions. Brian Hahn is the Director of Equities Research Australia New Zealand at Morningstar. Brian, welcome back to Fear and Greed.
Hi, Sean. It's a pleasure to be here.
Now, I do like the Morningstar Best Ideas publication. Comes out monthly. Just explain what it is.
Oh, sure. It is a report that we publish every month highlighting what our Morningstar analysts see as the most worthwhile stocks for investors to consider. So you won't see any stocks on this list that happen to be the flavors of the month. You won't see this list littered with stocks in sectors that are suffering from cyclical issues. And you certainly won't see any penny dreadful stocks on this list that day traders and even some managers like to have a punt on. What you will see are a select number of stocks drawn from across the whole spectrum of the market that have passed some quality screens and are trading at decent discounts to our valuations. And we do these best ideas not just for Australia and New Zealand, but also for Americas, Europe, and Asia.
Okay, so with that as background, let's jump into it. And let's start with Australia before we move on to other parts of the globe. It's a dynamic list, isn't it? So companies come on and off. And I know in the last week or two, there's been a couple of companies that have fallen off the list. Just who were they and why?
So, yes, that is correct, Sean. Last week, we removed WiseTech, which is a transport logistics software company, and AGL. Both have been removed simply due to their strong stock price performance, so much so that they are no longer trading at a sufficient discount to our analyst valuations. But there will be other reasons why certain stocks would be removed in certain months, and that would be perhaps because the fundamentals have changed or some industry events have happened. So as you say, Sean, it is a dynamic list that we update and reassess every month.
Okay, so AGL and WiseTech fell off last week. Did anything join? I mean, have you been buying anything?
Yes, we added two companies. One is AXS. I don't need to say too much about that. It's essentially a natural monopoly providing essential infrastructure to Australia's capital markets, and it is trading at a decent discount to our analysts' evaluation. The second one we added is quite interesting. It's a company called ResMed. It is a leading sleep apnea treatment company. It's performing quite strongly. There is excess demand for ResMed's products due to some supply shortages that we're having, and also due to a competitor who's having some internal issues. Now, you add to that the fact that we have aging population, obesity, and underdiagnosis of sleep apnea. I think these are all long-term trends which should support continuing demand for ResMed's products.
Okay, so that's Australia. Let's look beyond Australia and we'll start with the biggest market, which of course is Wall Street. Tell me about Teradyne.
Yeah, let me give you some background, Sean, because a constant frustration for Aussie investors is the lack of quality tech stocks on the AXS. Now, there are plenty of penny dreadfuls masquerading as such, but not many solid franchises. Well, there are a few in the US trading at decent discounts to our valuation. And one, as you say, is Teradyne, listed on NASDAQ under ticker symbol TER. It is basically a chip testing company which invests a boatload of money into producing high quality automated testing equipment. And it's highly leveraged to this whole industrial automation trend. It has a leading market share and superior products, profitability and customer relationships than peers. So that is one. And perhaps if I can give you another one, Sean,
Yeah.
and that would be Cognizant Technology. And that's also listed on the NASDAQ under CTSH. Now, it is not just a small dime a dozen mum and pop IT service provider, but a major player that makes a lot of money facilitating all the digital transformation work that's going on in companies around the world.
It's interesting, both those companies, Cognizant Technology and Teradyne, they are service providers to what's happening in the technology world. So, I mean, there's kind of opportunities, not just about the NVIDIAs of the world, it's actually the service providers to those companies.
Yeah, Sean, it's like the old days when the gold rush was on, and you can go on, get the gold, or you can buy actually shares in businesses that sell the shovels and the picks.
Mm.
And these are the companies that sell their services to, as you say, facilitate not just things in technology world, but in the real world, such as automation and digitization and transformation, which have become the buzzwords ever since we had that pandemic.
Stay with me, Brian. We'll be back in a minute. I'm speaking to Brian Hahn, Director of Equities Research Australia New Zealand at Morningstar. So let's shift to Europe. That economy isn't travelling as well necessarily as the US economy, nor the Australian economy for that matter. But you've picked out Accor, the hotels group, Anheuser-Busch. Tell me about Accor and Anheuser-Busch.
I guess that's one of the reasons why we wanted to highlight these best ideas because, as you say, Sean, not many people know that there is a company called Accor and that it is one of the largest hotel groups in the world. And it is leveraged to that whole post pandemic recovery in global travel activities. Now, it has brands catering to all segments of the market from raffles and Sofitel for, rich people like yourself, Sean,
Yes. Talking my language here, Brian.
to Ibis, to Ibis and Break Free, catering to cheapskates such as myself.
I think you've got that confused somewhat. I think you got the names mixed up there, Brian, but go on.
Yeah, but the interesting thing is the shares are still undervalued relative to what our analyst thinks they're worth. But another one, as you say, is Anheuser-Busch InBev, which is listed on the Brussels Exchange, and it makes 500 different kinds of beer brands, including Corona, Budweiser, and Heineken. And the company has dominant market positions and much lower cost structures than peers, and especially leveraged to big developing markets such as Africa and Latin America.
Okay, now we often talk about Wall Street. We sometimes talk about Europe. Here on Fear and Greed, we don't actually talk a lot about the companies to invest in Asia, but it's such a big part of our market and China specifically. A couple of examples there that you think investors is worth having a look at: China Merchants Bank and then China Overseas Land and Investment.
Yeah, exactly. And, it's funny you should mention that because Asia is full of developing countries with huge populations and growing wealth. So if you can find shares in companies that serve these markets and can buy them at a discount to what they may be worth intrinsically, why wouldn't you consider them? And the two that you mentioned, one would be China Merchants Bank. It has a leading market position in the Chinese retail banking space and is also making big inroads into wealth management. The bank has an industry leading return on equity because it has such a asset light business model. It has a very well off customer base, prudent lending practices, and pretty low funding costs. And at the current discount to our analyst valuation, I think it's certainly worth a look for Aussie investors who may be filled to the gills with our four major banks. And the other one you mentioned was the China Overseas Land and Investment. Now, this real estate company operates in the very competitive and fragmented Chinese property development space, but it has been one of the few to achieve market share growth in recent periods. And they have done this by focusing on land bank quality upgrades and acquisitions. And it mainly operates in wealthier cities in China. So it should do well as homebuyer sentiment in China continues to recover.
Brian, plenty to think about in all that. Thank you very much for talking to Fear and Greed.
Pleasure, Sean. Thank you.
That was Brian Hahn, Director of Equities Research Australia New Zealand at Morningstar. This is the Fear and Greed business interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.